Welcome everybody to our Leaders in Housing Counseling call and one more of our special COVID-19 editions. Basically today our plan is to give you some legislative updates, what Melody's seeing on the Hill and with Congress and Senate. I'm actually going to insert, it's not on the agenda, but I'm going to insert a little bit of a just update on what we're doing on certification and getting the deadline moved and trying to get the awards released. Some of you may have seen the letter. I'll talk about that for just a minute, what the response has been so far. But most of the call will be devoted to credit scoring, credit issues, and COVID-19 crisis. And we have Kelly Cochran from FinReg Lab, and she's deeply knowledgeable about how these things work. So you're going to see and take it apart in great detail in a way that helps you understand how these pieces move along. Obviously, there have been some policy announcements that have been helpful around some of the issues we were most concerned about, but this will be helpful to all of us. We'll do a quick plug on NHRC membership, and thanks to everybody who's been renewing, and we have had some new memberships. And then, we understand that it's not the easiest time for people's budgets, so really appreciate those that can step up and understand if it's not the right time for you. Our next call, I want to alert you to, this is going to be our participatory call. So we don't have outside speakers. We'll have some resource people from like the National Law Project and maybe others, but the idea is to hear from you about what's happening on the servicer side. And we really want kind of what your experience has been in the last couple of weeks. We are asked often to explain and talk what's going on in the marketplace. A number of you participated in different ways in helping us understand this, but I thought it'd be very good if everybody hears from each other. So this is one where Melody and Ellie and I are kind of going to sit back and we're going to let it roll and just see what people have to say and give us some what you're hearing, what you're seeing. We're emphasizing mortgage servicer stories. There's some renters things we need to hear about. That's fine. We'll probably do a similar one on renters if this works well. But really trying to focus in on kind of what's the current cutting edge and bleeding edge of our work and what we should be telling regulators, what we should be telling legislators, what we should be telling financial services industry people. So please plan on that, and please plan on raising your hand, and we're going to let people speak. You can still do it through the chat box if you want, but we're going to try to do it as more of an open forum so we can get more of your feedback. So please plan on that. So Melody, tell us what's happening in Congress these days.
Thank you, Bruce. Hello, everyone. The big news that we're really, really excited about, as you know, the HEROES Act has passed the House for the HEROES Act has passed the House for $100 million for housing counseling. It is now over at the Senate. But while they're having those talks, Bruce and I got word that Senators Menendez, Democrat from New Jersey, and Brown, the Democrat from Ohio, as well as the ranking member for Senate Banking Committee, are in talks to introduce housing counseling legislation. This legislation would be modeled on the bill that was similarly introduced in the House that was included in Chairman Waters' proposal to Speaker Pelosi that ultimately did not get, the final legislative text was not included in the HEROES Act. But what this bill would do was that it would fund $700 million for housing counseling assistance. It would allow equipment and technology to be eligible expenses based on feedback we've heard from counselors around the country. And it would have funds go through NeighborWorks as opposed to HUD. We heard from several different agencies that they felt that if funds went through HUD, it would probably take too long, or it just wouldn't be as immediately available as groups will need right now, given the crisis. Given that NeighborWorks administered the National Foreclosure Mitigation Counseling Program during the recession, and that was a very successful program, legislators felt that NeighborWorks would be a good vehicle given the scope and scale of the crisis we're facing now, especially in the wake of a foreclosure and eviction crisis, what we're hearing in different groups around different states around the country. Next slide. So I will be brief. Menendez as well as Brown are seeking bipartisan support, preferably from Senate Banking or Appropriations Republicans. As you guys may already know, it's very, very difficult for anything to move in the Senate, if not through bipartisan support. We've heard directly from the chairs of both Senate Appropriations and Banking, both of which are Republican senators, that while they may support housing counseling, they absolutely do not want to go ahead of their other members, and they want to make sure they have committee buy-in before really pushing legislation for markup. And so in order to ensure that we have as little controversy as possible around the bill and moving it through the Senate, it's very, very important that we get Republican support. We have a bit of time. I know that the Senate is in session next week, but we don't have an exact timeline on when Menendez or Brown's bill will actually be introduced. We were told that they will introduce it with or without Republican support, but that they would like members of the GOP to sign on to the bill. So our hope here at NHRC is to build as much Republican support as possible. We've already started having those conversations with both Democrat and Republican offices. We're prioritizing Republican offices, particularly in banking. So please keep an eye out for emails from me, whereas we might have some conference calls or additional types of advocacy with these lawmakers of interest. And I'll send it back to Bruce.
Okay, good. Yeah, no, it's we continue to be front and square in any of the conversations around what legislation looks like. In the House, Melody mentioned that we were in the NeighborWorks. There was a bill that had NeighborWorks in the funding, and that NeighborWorks is in the Menendez-Brown as the vehicle. And it ended up in the House that the version that ended up in the HEROES bill was for less money, $100 million, and it was going through HUD. And I mean, our official position is we'll work with whatever is available, and the job is really to get the funds out as quickly as possible. And if we have ideas about how to do that, regardless of who the vehicle is, and that there's money available, the flexibility to pay for technology and equipment to deal with outreach and the new world of virtual communication, that it has our ability to not only pay for overhead and staff, the kinds of things that we normally do, but also that it allows us to build our strength in going forward. And we continue to be, and Melly's doing great work about really connecting with all the players on this, and we'll continue doing that work. I'm going off agenda just a tad here, and many of you have probably seen that we sent a letter signed by a number of the counseling networks to HUD yesterday, and it was a very short letter. It had 2 points to it. One was please move forward on announcing what the awards are for the 2020 housing counseling funding, and the second one is please announce what the plans are for providing an extension for the HUD housing counseling certification test and the deadline for the program. And as many of you may remember, way back in early March, first or second week of March, we did a letter to HUD asking that it be deferred, and we know they've been under serious consideration, and we've been concerned about how long it has taken. A lot of you have brought this up to my attention, others' attention. We know this entirely. You know, this is kicking around in many places, and it's been a source of some concern and frustration. So the whole point behind the letter was that it was to try to get senior leadership at HUD to push this over the line. And we did get a very warm response from Dana Wade, who is the new FHA commissioner, who oversees the Office of Housing Counseling. And she both said she promised to look into this and also to, really say how respectful she was of the important work that housing counseling agencies were doing in the field, the work that you were doing. So a week or two ago, the NCRC had a sign-on letter on this as well as funding. And we, all these issues are, all of us can push. It's certainly fine to bring it up at any time to relevant people. This is all part of, we just need to keep the pressure on to keep this, get these kind of issues behind us so that we can concentrate on building and growing. So with that, let me turn it over to Ellie to do our featured program today. Ellie?
Thanks, Bruce. Hi, everybody. So our presenter today is Kelly Cochran. She is the Deputy Director at FinReg Lab. She helped to stand up the Consumer Financial Protection Bureau, where she served most recently as the Assistant Director for Regulations. And in that capacity, she oversaw rulemaking and guidance activities under the Dodd-Frank Act, Electronic Fund Transfer Act, and various other federal consumer financial laws. So I heard Kelly do a portion of or a version of this presentation on another call, and was so impressed at the job that she did explaining this really kind of confusing situation that's going on. And so I asked her to come on this call, and luckily she said yes. And she has kind of increased the PowerPoint, and she has been willing to accept some questions outside of what is specifically related to COVID-19 credit reporting, and is going to do her level best to answer the questions that you all are going to bring to her. So Kelly, welcome, and take it away.
Great, thank you. Thank you for a nice introduction, and thanks to everyone. I really appreciate the chance to talk with you all. If you can go maybe to the next slide, I'll just talk for a second about what FinReg Lab is and then launch right in. We're a relatively new nonprofit organization, less than 2 years old, and our focus is really on looking at data and technology and ways that it can be used to help encourage better practices and financial inclusion in the financial system. Our first really big project was looking at the potential use of bank transaction account data in credit underwriting for both consumers and small businesses. So we tested some data that's actually in use in the market today, and then did a number of follow-up policy reports on different aspects and issues that are raised by the potential use of this data. And in the course of that work, we learned, a great deal about the kind of traditional credit reporting system and credit scoring and kind of the traditional underwriting models. So as the spring has evolved, we realized that we're really hearing a lot about concerns about disaster-related credit reporting, and published a shorter piece about a month ago that's available on our website that kind of explains the traditional approach to disaster reporting, what the CARES Act did, and some of the policy debates around whether additional legislation might be warranted in this space. So what I'll cover today is a lot of the same material, but you may want to go back over that longer report if it's useful. One thing I'll mention too is that we're thinking about doing an addendum to that report, maybe sometime in June. We're not quite sure the timing yet, but focusing in particular on how as people come out of short-term forbearance plans and look at different repayment structures, how those could be potentially reported, and where there may be credit scoring ramifications coming out of some of those longer-term decisions. We're starting to hear more questions about that, so we're thinking that may be a useful follow-up activity. But so anyway, we can go ahead and jump in from there. If you can turn to the next slide. So as as Ellie and I talked, she said it would be helpful to start with just the fact that the CARES Act implementation on credit reporting provisions has really created a lot of confusion. There's a number of headlines here that I just pulled from about the last 2 weeks with a number of stories that touch on some of the questions and concerns that are coming up. And so just trying to explain kind of what's happening here and why there's so much confusion. If you can move on to the next slide. Our sense is that there's really 3 factors kind of all creating a perfect storm. The first is the way that historical codes under the Metro 2 standards work, and that there's some variation, and a lot of decisions are left up to furnishers to make. So there can be a number of places where there are inconsistencies, and the treatment of the codes can also vary. So I'll explain that in more detail, but that's definitely part of what's happening here. The second piece is that there's some confusion about the scope and the execution of the CARES Act requirements. I think sometimes they were described early on as stopping all negative reporting, and they're not really that broad. And so there's both some confusion as to the scope, and then also there appear to be some problems in how they're being implemented. And then the final piece here, particularly in the mortgage space, is that there's origination and securitization factors that may be affecting the way that lenders who are evaluating refinance applications are kind of treating the information that's available in credit reports. And so all 3 of these are coming together and causing, different confusion in different areas. So we'll kind of unpack this a bit. If you can move to the next slide. The traditional way of dealing with disaster-related reporting in Metro 2, it really comes down to a couple of different avenues, I guess. The first is that there are some special comment codes that are often used in disaster situations. One is AW, which is affected by a natural or a declared disaster, and one is CP for forbearance. Now, these codes are kind of considered to be special optional codes. They are not required and not always used by every furnisher. Generally speaking, only one of them can be used at a time. And there's a number of decisions that come into play as furnishers are deciding whether or not to use the codes. One other thing that's really important about them is that they're not captured with as much historical detail as most of the regular fields in a consumer report. So while the furnisher is using the code, it will appear on a consumer's report for the particular trade line. But once they've removed that code, it will no longer be visible to anyone. And someone who later pulls the report may not know that code was ever on the report. So that has some ramifications as to how people decide to use the information, because they don't have as much historical precision about when a code was first entered, when a consumer is first affected, and then when the code is coming back off the account. The other thing that kind of overlaps with the special comment codes is what are called D characters. And these are used in a couple of different fields to note deferral. So the D character can show up either in terms frequency and in payment history profile, which are 2 other fields. But especially in payment history profile, D is also sometimes used for other situations that are not disaster related, but just where information is not available due to a bankruptcy or something else. So they have a little bit different meaning, and they can be used at the same time as the special comment codes or just by themselves, which can cause some confusion for people depending on kind of where they're looking. These 2 fields are generally considered mandatory, and there is more historical information collected about them. So as we get through this, you'll see why that is potentially important. If you move to the next slide. So there's a number of sources of inconsistency that can happen with the use of these historical codes. The first is, as I said, furnishers have kind of some optionality as to whether they even use the special comment codes, whether they think it's helpful to add them to explain kind of what's happening to the consumer's accounts or not. We know from past natural disasters, such as hurricanes and the like, that historical usage rates really vary widely. After Hurricane Harvey, the CFPB did a study and found that some mortgage and I think auto loan servicers were using the codes for more than 50% of their accounts within the Houston area. Some servicers, in contrast, were only using them for a handful of accounts. So really varied patterns, and so that can be part of the source of confusion as to kind of what's happening and how often furnishers use them. I think particularly in this case with the pandemic, because call volumes increased so rapidly, we're getting the sense that servicers may have tended to err on the side of using the codes. And whether that was a good thing or a bad thing, it turns out to be kind of complicated. And I think people may not have fully understood how the codes got used at the time that they were kind of placing them on the accounts. That relates to the second bullet here, which is third-party scoring models. So FICO and VantageScore don't use the codes the same way. FICO doesn't really look at the special comment codes or the terms frequency field. And that's in part because of this historical data question that I mentioned. Because they don't know when the special comment code was entered, they don't know at what point the kind of impact has hit the consumer. And so it gets more complicated to kind of know what to do with the information. They do account for D characters in the payment history profile field, but they generally don't take them in account in a negative way. VantageScore is a little bit more complicated, where there is an AW field, an AW code. They will ignore the negative payment history for that account while that AW field is in effect. Where there are D characters being used, they actually do not look at the deferred balance that's in question, and that later practice can have either positive or negative effects on scores, kind of depending on the individual consumer's circumstances. So VantageScore announced a few weeks ago that they were actually in the process of adjusting their most recent two models to minimize the potential that there would be any negative impact associated with this this aspect of kind of their scoring systems. Our understanding is that's in progress right now and is in the process of being played out. And it became really important in terms of consumer awareness because although VantageScore is not really used much in mortgage lending, it is often used for a number of consumer credit score monitoring services. So people started to see some changes in their VantageScore scores and got concerned that it was going to potentially affect them. So there's been, some growing awareness of this and some press coverage, which, is kind of adding to the number of questions, I think, in this area. The final factor that can create inconsistency is that, of course, individual lenders have wide variation as to what they do with this information, both in terms of how much they're relying on third-party scores like FICO or VantageScore, whether they're looking at the underlying credit reports and pulling some of those attributes, and then how they treat any of that information, whether they treat it as a positive or as a negative. So the net kind of picture here is that even though people have historically thought of these special comment codes as being kind of a neutral to positive factor for consumers, what seems to be happening in practice is that that's not always, in fact, true, and that the length of time and the way that it affects consumers can really vary depending on which scoring model you're using and what the circumstances are. So it's a lot of confusion in this area and a lot of variation in kind of how this is playing out in practice. If we move on to the next slide, we'll talk a bit about how the CARES Act layers in here. Now, the CARES Act really focuses on the status of the account, an individual account, and whether it's reported as current or delinquent. And the basic concept that it's applying is saying that if a consumer was current going into the pandemic, their account will continue to be reported as current for as long as they are in compliance with a forbearance or deferral. So if the consumer calls in to their individual lender or servicer, they get an accommodation, the CARES Act kicks in as to how that's being reported to the system, to credit bureaus, but it doesn't affect anything besides kind of this question of current versus delinquent. And in a situation where a consumer might have already been delinquent, it basically freezes the level of delinquency. So if they were 30 days late prior to the pandemic, it would continue to be reported at that level for as long as they're complying with their forbearance or deferral, although consumers could cure during that period if they're able to bring their accounts current. So Our sense is that this is helpful because a kind of payment history is so important to credit scores. This will be helpful to most consumers. If they call in, they get the accommodation, and it's reported in compliance with the Act. But there are still a number of places where there can be variation here too. Part of it is that the length of the accommodations and the nature of the accommodations themselves can vary. The CARES Act sets certain minimum requirements for federally backed mortgages and certain federal student loans, but outside of those two product areas, it's really up to the individual lender or servicer to decide what types of accommodation, if any, they're willing to grant. So the period in which this is helpful to consumers in terms of their credit scores may really vary depending on what relief they're getting from their individual lender or servicer. The other thing is that industry generally, as there's been lots of education programs going on right now to try and make sure that furnishers are kind of processing all this and kind of complying with everything. They're generally focusing on both doing the CARES Act requirements and using the historical codes. So both sets of information are kind of in play right now. And so, we can have things happen where people may be implementing the CARES Act correctly, but the kind of differences in how different models are treating the special comment fields can still be occurring kind of at the same time. So that's making it a little bit more confusing for everybody, if that makes sense. We've also heard a few reports that furnishers may have a little bit more difficulty when it comes to their systems in complying with the CARES Act where someone is already delinquent, because their systems aren't really designed to kind of freeze a level of delinquency. We haven't had a chance to go very deep into that, but we understand there may be a little bit more challenge in that area. If we can move to the next slide. And then the final piece here is, as I mentioned at the beginning, there are questions about how kind of origination standards and securitization factors may be kind of interplaying with these things. As we said, lenders are free to use this information kind of however they choose to use it. There's no restrictions on them. And particularly in the mortgage market, there are a number of kind of considerations, for instance, with the GSE rules that I think when Congress, adopted the CARES Act, they weren't kind of thinking downstream to this aspect of it. But this seems to be playing out in the space where consumers are now starting to turn and look at refis and whether they're able to obtain them or not. There are a couple of reasons why lenders might be reluctant to give a refi to a consumer who has something on their credit report that indicates that they were either they're actually in forbearance or have been thinking about forbearance in response to the pandemic. The first is that historically the GSEs refused to purchase loans in forbearance, and so in April they did announce that they were softening these rules a little bit, but they imposed really substantial loan level pricing adjustments, and it still may not be kind of financially viable for consumers and for lenders to go ahead under those circumstances. So that's one question and concern that may be causing some refi denials to be occurring. The second is that the GSEs have generally required 12 current full payments on previous loans before they'll purchase a new or securitize a new refinance mortgage. They announced just a little bit more than a week ago that they would start purchasing mortgages of borrowers with pandemic forbearances, but it's only occurring in a couple of circumstances, and this information is so new that we're still kind of waiting to see how the market reacts to it. So what the GSE said is that if a consumer is in fact current on their mortgage, even though there is a forbearance flag on their report, that they could go ahead and refi and that the GSEs would purchase. So this could occur a situation where a consumer is in forbearance or has a forbearance flag, but in fact has been making full payments on their mortgage, or if they've reinstated their mortgage after a previous forbearance and kind of got caught back up and are ready to go. The second thing the GSE said is that they would purchase mortgages, in situations where a consumer has finished a forbearance and then made 3 consecutive payments, even under a repayment plan, a deferral, or a modification. So So that's a really important piece because people were concerned that potentially if someone had taken a forbearance, they might be kind of blocked out of then doing a refi for some substantial amount of time, maybe even 12 months after the forbearance had completed. This is shorter, but as I said, we're kind of still waiting to see how the market reacts to this and kind of how everyone moves forward since it's so new. In terms of the kind of policy debates going forward, there's a number of consumer advocates and some legislators at the time that the CARES Act was adopted argued that it really wasn't going to be enough. And so far, most of the debates are focusing on kind of broader, what are called suppression options that would bar more negative information from either being reported or used by lenders, depending on the particular legislation. There's a couple of different structures that people are considering, but the basic idea, we've kind of outlined both what's in the HEROES Act, and then there are a few state laws pending that are also kind of thinking about these ideas. I'll cover this part pretty quickly, but we can, of course, come back to it in questions if people are interested. If you move on to the next slide, just real quickly, part of the reason that people are interested in suppression is that the historical approaches we just talked about have some kind of real cons. It really depends on the consumer to initiate a kind of change in status on each individual account by reaching out to their lender or servicer. And we've seen a lot of inconsistency in implementation. And because the fact that third-party scores use this information differently, the effect on consumer scores is kind of uncertain. It's temporary. Once the flags are removed, it doesn't really have any effect. And in fact, later lenders can't even really see they were there. And it's really only used in the credit space, not so much with like utility or medical debts or anything like that. On the next slide, with the CARES Act, although our sense is that kind of addressing the account status as to currency is important for credit scores, there's still some concern that other fields or factors could affect scores in different directions. And most of all, I think people are concerned because it still relies on consumers to call to get an accommodation. And because those accommodations, as I mentioned, are kind of inconsistent as to length and kind of structure, there's a concern that the CARES Act just may not help for very long, depending on kind of how individual accommodations are sorted out. The law also specifically was focused on credit obligations. So again, it's not focusing on things like utility or medical debts. The next slide is focusing on kind of the pros and cons of a broader suppression approach. Some of the things that people like about this is that it can often, depending on how the individual legislation is structured, it can be structured to apply more and be implemented more by the consumer reporting agency instead of all the individual furnishers. And for instance, the federal legislation would kind of categorically suppress negative information for consumers and not rely on a lot of initial kind of follow-up by individual consumers to get the process started. And one of the other things is that it would potentially apply more broadly to other categories like utility and medical debts. There's at the same time a number of concerns about these kinds of options. One is that depending on how it's structured, it might just block out a lot of information. And especially if it's not really dependent on the consumer kind of having specific information about kind of how they've been affected by the disaster, you're potentially blocking out not just the disaster effects, but other types of credit risk. So that makes lenders potentially really nervous. Some folks have told us they're concerned that lenders would just tend to rely less on credit scoring and credit report data and more on kind of really simple rules of thumb that might make it really hard for even more consumers to get credit. No matter what's happening to their score, the score just won't matter very much because people will be less trustful of the system. So, there's a number of concerns there, and it'll be interesting to see what happens going forward to see if some of these options kind of gather traction or kind of what happens next. If you can turn to the next slide real quickly, we talked just a bit in our report about some of the considerations as people are looking at options here. I think one of the things that really stands out to us is just that the system is so complex. It can be hard enough to figure out exactly how a particular change might affect the credit reports for the big nationwide credit bureaus, and the third-party scoring models that people tend to focus on the most. But you really have to think beyond that, because it also depends on what do the furnishers have to do? How easy is it for them to change their systems or their practices? What do the lenders do with the information that they're being provided? And does any legislation limit their activity, or does it just limit things that are farther upstream? And another concern is just how do all of us turn out of this pandemic? We know that credit underwriting and scoring models usually go through an adjustment process anytime there's a large economic downturn. And if we end up with less information about how kind of finances are starting to stabilize, it may be harder to get that adjustment process accomplished. And so there's concerns there as well. And then finally, it's just kind of what's the trust in the overall system at the end of this? And if lenders or investors view the system as less reliable, then there are potentially kind of, you know, unintended consequences there that are not what people are trying to have happen. We also pointed out that there may be some ways to reduce burdens on individual consumers other than just a flat-out suppression option. One is that the National Foundation for Credit Counseling has been working to kind of batch communications when consumers come in, to kind of reach all the lenders or servicers that are affected at the same time, so that people have to spend less time calling one account at a time to get relief. And there's some interest, particularly at the state level, about kind of a system where if there is going to be some sort of flag on an account, that it's applied at the consumer reporting agency level rather than at the individual furnisher level, kind of similar to what identity theft alerts work today, so that at least that part is also a little more centralized. Next slide. And then the last couple of considerations that we flagged are just, one, some of the options that are kind of on the table, both with regard to this historical system in the codes, because there's not much information about exactly when they're being applied to the account, and then when the kind of disaster period has ended for the consumer, and also some of these more kind of aggressive suppression options, to the extent that what they end up doing is kind of blocking information that's not actually related to the disaster. That gets really tricky. It can be simpler to implement, but it creates more concern on the lender and investor side that they're losing information that they really need to have to forecast credit risk. And so I think that's a complicated question. Some of the federal legislation would apply not just to the pandemic, but potentially to kind of future disasters in general. And it's tricky because what's viable right now and can be implemented in the short run versus what might be able to be done after this particular crisis is passed is tricky. And there may be options that we're not really considering right this second because they're not immediately viable for implementation, but they might be, give more options going forward. The last thing we noted is just that there's a couple of broader issues and tensions that are kind of funneling into the debate about credit reporting. One is just that this concern about the accommodation programs, the fact that they're not consistent and there's uncertainty about how much government assistance will be available for hardship cases. The more consistency there is on accommodation, the more assistance there is available, the less people are going to have to worry about delinquencies on the tail end. And then the broader question is just, where do we go next with credit scoring and underwriting and reporting systems? How do we make them more inclusive over time? How do we adjust them coming out of this crisis to help people recover more quickly? And that's a much broader, longer-term conversation, but some of these issues are starting to implicate those as well. So that's an overview of the report. I'd be happy to answer questions. I know it's a lot of information, and I can also always take email later, but would be happy to talk now if people had immediate questions or follow-ups.
Thank you so much, Kelly. That was really, really informative. One thing that I want to clarify, just to be very concrete about it, I'm pretty sure that what I heard you say is the CARES Act does determine that lenders are not to report somebody as delinquent, but those other codes, the AW, the the other disaster code that isn't coming to mind immediately, and then the D codes. Those are all proper and acceptable and are not anything that is breaking any rules under the CARES Act.
Right. So a couple things, and if you want to go back up in the slides, we can go to the first big slide on the CARES Act. So yes, so generally speaking, if the consumer was current before the pandemic hit, they get an accommodation and they comply with that accommodation, they should continue to be reported as current. And that really affects a couple of fields. It's account status and account payment history profile. The fields that, now, if they were already delinquent before the pandemic, they will continue to be reported as delinquent unless they cure, but the level of delinquency shouldn't get worse. So the CARES Act is really focusing on this kind of question of current versus delinquent. The fields that we were talking about before, kind of the historical fields that have been used to note where a consumer is kind of affected by a disaster, aren't necessarily focusing on the question of current versus delinquent. There are other fields, and so it's not, you could potentially use those and comply with the CARES Act. They're not necessarily in tension with each other. We think some of what may be happening is that people have been overusing the special comment codes. Our sense in talking to people is that if a consumer merely calls in and asks, what are my options? I want to understand what this forbearance thing is, but they do not want a forbearance and they do not accept a forbearance, they should not have a CP code on their file. Our sense is that servicers have been overusing that code, and potentially AW is a little less clear as to when it applies, but both of those special comment codes are showing up a lot right now, even for consumers who actually are not in a forbearance program. It's quite possible servicers thought they were helping consumers by just flagging that they may be affected and that there's something going on beyond their control. What they may not have understood is that lenders might, especially mortgage lenders, might see that as a risk factor because of all those securitization factor rules that I was talking about. And so we think what's happening is that people are being a little over enthusiastic on using some of these codes, kind of the historical codes. It's not necessarily means they're out of compliance with the CARES Act, but then when the lender is going to evaluate a refi application, they may be making decisions that are kind of unexpected and not what Congress was trying to accomplish with the CARES Act, and not what, frankly, you know, people thought these codes would ever be used for. So it's like I said, it's all three of these factors kind of coming together at the same time that is creating some of the complication and confusion.
So can I just follow up on that? Just as a,
sure.
So I think the issue for us is, what do counselors say when people come and say, I don't know whether to take a forbearance or not? How will that affect me in the future?
Well, there's a couple things to think through here. First of all, if, you know, forbearances, as everyone knows, forbearances have consequences that are not free money. If a consumer needs a forbearance, that, you know, forbearance is potentially helpful to them. It's potentially far more helpful to them than going delinquent, which will definitely ding people's credit scores. There are questions about how people who have had forbearances come out of forbearance at the end, how those payments are structured, and kind of what their long-term kind of, you know, repayment plan is. I can talk a little bit about how we think that's going to play out. We think that's kind of still you know, kind of in motion. The other thing is, if the consumer has called a servicer or a lender to just ask what their options are, it may be really helpful to access their credit reports. Right now, can be provided on a weekly basis. See whether any of these codes are showing up and whether they're accurate. If the consumer is actually in a forbearance plan, then it makes sense that you would probably see the CP code, you know, as we talked about. If they're not actually in a forbearance plan, then you may want to ask that code be removed. Go ahead and put a dispute in on it, just to reduce the chance that somewhere downstream someone sees that code and treats it in a negative fashion if the consumer then later goes in for a refinance application, or, you know, some other form of credit downstream. In terms of the questions about what happens at the end of the forbearance, kind of here's what we know so far. So forbearances are usually thought of, especially in the mortgage space, as being a pretty short-term payment relief option. The way that the money that has, the payments that have not been made gets paid back can vary. Sometimes it's a balloon right at the end of the forbearance. Sometimes it's a relatively short repayment plan that pays the extra money back over like 3 to 12 months. And sometimes the amounts will get moved to the end of the loan in different structures. All FHA, USDA, VA, and the GSEs have all been trying to make clear over the last several weeks, some cases even into April, that people should not be required to pay a lump sum payment immediately at the end of the forbearance if they cannot afford to do that. That's not the only option, although it is an option, and if consumers can do that, there's some advantage, because in terms of going forward and being able to qualify for refinances and so on, they may want to do that if they can, but they don't have to do that. But the structures that are being used to repay kind of vary, and some of that is still getting sorted out. FHA announced in April that they were creating an option that would move whatever payments had been missed to the end of the loan, kind of treat it as a non-interest balloon payment that would just be paid off at the very end, when the loan is paid off or refinanced, and that it would be structured kind of as a lien on the property. The GSEs a few weeks ago announced that they were moving towards a similar approach, where there would be what's called a COVID-19 deferral option that would allow consumers to kind of pay off that balance kind of at the end of the loan. But it is not yet in place. It won't be in place until July 1st, and we think some details are still getting sorted out as to whether it would be structured as a loan modification or a lien. It may depend on the state. That's something we're still trying to track down. I think there are some questions about how these different types of options will be reported to the credit reporting system and how they'll be treated. We know in the last crisis that loan modifications, that the reporting on modifications evolved a bit over the course of the stabilization process. These kinds of options that we're talking about now, coming out of the pandemic, the expectation is the consumer is going to pay what they owe. It's not a principal write down or anything complicated like that. It's just a question of kind of when they pay it. And so we're in the process of talking to various industry folks. I think they're talking to each other to figure out the best way to report this, to make sure that that consumers aren't, that they are not reported in a way that causes undue damage to credit scores. But that dialogue is still going on, and so that's one of the reasons that I mentioned at the beginning that we're thinking about doing a follow-up. As that gets a little more settled, we're hoping to do a short follow-up that'll explain kind of what the major options are and kind of how the codes that are related to those options may play out, because they're not the ones that we've kind of talked about in this presentation today.
Yeah, I want to emphasize sort of for the practitioners in the field that forbearance is an important and useful tool, as you said, and that there are, for most people, there will be a resolution that will be helpful and will not force them into crisis the minute that forbearance comes to an end. So the tool they're talking about, so Fannie and Freddie have cap and extend, and they have extend as those are coming to an end, or they'll be much less used after July 1st, I guess it is. They'll use deferral. It essentially is not a modification, which means that you don't have to produce all the paperwork that we had to produce on the loan mods in the foreclosure crisis. This would be essentially a raise your hand if you can continue making your payments as you used to before the crisis. And then it goes into effect. It's not a modification, so there's no new paperwork that has to be filed in terms of restructuring the loan. It does end up being what we call a silent balloon on the end. They tend not to use the term balloon, but that is what it is. But it's but partial claim has that same program technique, and what it does is essentially at the end of your loan term, you'll have a balloon that needs to get dealt with, either because you're refinancing and gets rolled into the refinance, you're selling your house, it becomes part of the sale price. You can deal with it in other ways. You can refinance it to get it to disappear at some point if you need to. So I think what I'm worried about, and what we hear a lot from clients, is a fear of taking a forbearance, and then the question, does it close off your options on refinancing? So as you pointed out, at least for Fannie and Freddie, there's now a clear policy that should not be in the way for that. As long as people make 3 months of timely payment. Unfortunately, that isn't a policy that applies to the non-government loans. I don't know where VA and FHA and USDA stand on that, but I think it's important to kind of have the bigger, longer-term effect, view of this, which is that forbearance is a way we're going to get people through this crisis, and they should do it. And some people are making payments by not dealing with other parts of their financial world, like getting their medicines, kinds of things. And people certainly have the right to make those choices, but forbearance is probably a less harmful choice for most people. Is that a fair summary?
Yeah, I think so. I mean, we have heard some suggestion that there's still a little discussion underway about the paperwork requirements for this new deferral option under the GSEs, but we definitely are hearing there's a lot of interest in making them streamlined and not doing the full kind of traditional approach that was used in the last crisis. So my sense is that that'll probably get sorted out in the next several weeks. I do think it'll be important to have consistency, and I expect that there will be a lot of education programs in the industry as well, just as there were right after the CARES Act, to try and make sure that people are reporting these appropriately, because some of the codes that were used in the past for loan modifications do have negative effects on scores. They're not necessarily as severe as some of the alternatives that people were looking at compared to mods last time, but especially in this circumstance where consumers really are expecting to pay the full amount owed, it's just a question of when. Some of those codes may not be the best way to report those. So those things are still in progress, but I think they're moving in a good direction, and hopefully we'll have more clarity soon. And I agree. I think that, where people need forbearances, it makes sense to use them. It's just helpful to kind of watch for some of the places where the process can break down and try to make sure that the reports are getting to the right place, and so that consumers are in a good position as they move forward and they stabilize and kind of move out of this stage, so that there aren't any unintended consequences there. So, it just takes monitoring, I think, but it doesn't mean that forbearances aren't really important and really useful. They really can be here.
So the other good news is that the housing advocates, many of whom have been on these calls repeatedly, are all over this, and I know that it's an area that even the financial services industry has been concerned about, and it's a common topic of discussion in many of these Zoom conversations.
Yeah,
to try to monitor
yeah. It definitely is getting a lot of attention, and even since we published the report in early May, we're continuing to see kind of more coverage and talk to more people who are focusing on it. We have seen some reports. I think on that first slide, I included a couple of sources. There are some reports of overuse of the special comment codes in student and auto as well. The auto we've just heard more anecdotally, not so much in press, but it's important to, as folks are working with individual consumers, it's important to be looking kind of across their entire report to confirm whether they are in fact in an accommodation or a forbearance for other credit as well. So it's not just a mortgage issue. So.
Right. Well, let's go to questions.
Thank you. We just have a few. How do clients request that codes get removed?
So, as I said, the AW code is a little bit squishy as to exactly when it's used. But in particular, if there's a forbearance code on the account and there is no forbearance plan in place, our understanding is that is something that you can dispute, just like you would dispute any other inaccuracy on a credit report. You can file those either with the consumer reporting agency or with the individual furnisher, and you can do both. And, the normal rules apply. They have usually about 30 days to investigate and so on and go through that process. We have heard anecdotally that some people are having a little bit of a hard time with disputes on this, but I think it's just important to be persistent, and as the press is growing on this, I suspect that those early issues will probably get sorted out because people are becoming increasingly aware that these codes can in fact sometimes have negative consequences and that people need to be more careful. We think early on servicers may, like I said, have thought they were neutral to helpful to consumers, and that's not always true. So it's an education and awareness, but you would treat it just like any other credit reporting dispute.
Thank you. How will a forbearance option affect someone who is due for a principal reduction due to the HAMP incentive program for a previous modification? As part of the program stated, they must remain current for 5 years since the trial began.
Oh, wow, that's a good question. I don't know the answer to that. We haven't really had a chance to focus on the intersection between kind of HAMP and the new kind of set of issues. So I wouldn't be able to speak to that today, but maybe that's something that, we can find a way to follow up on.
I think that's an important question, and I've heard in these that in fact they're sorting that out, and that it won't affect people's prior modification, including HAMP mods, and so there's a variety of aspects of this. But please do the deep dive, and we can circulate it. Glad you brought it up because that's an important issue.
Thank you. Is there any talk with the 30% FHA max claim amount for those who have had assistance during the last crisis? And this is regarding the special forbearance.
I don't know the answer to that question. I'm at this point a little more familiar with what the GSEs have been doing recently than what FHA has done on their program. So I don't know the answer, but again, that's probably something that we can try and find out.
We might we'll have you for the National Housing Law Project next week, so it's fine to bring that question up as well too, so that
they may not be able to get to the answer. Yeah, they may be able to get to the answer faster than we can. So that sounds great.
Thank you. What if a consumer asks to remove a code and they refuse to do so? What rights do the consumers have?
Well, as I said, you can go both to the consumer reporting agency and the furnisher, and I'm a little rusty on the details, but there are ways that potentially you can place kind of a notation on the report showing that something is at least disputed, even if the two sides don't reach ultimate agreement. So going through those processes is the first step, and see where that takes you. As I said, our sense is that may start to get better quickly as people understand more of why this is important and why this is potentially harmful. So hopefully people will not get to the point where they can't get the codes off, but that's still kind of a moving target at this point.
Thank you. If a homeowner has completed a bankruptcy and did not validate the debt, how will the lender verbally How will the lender verbally give a payment history? Yeah.
Oh, that's a good question. We have not been focusing on bankruptcy issues as much, so I don't know the answers to that. But again, maybe that's something that there's a way to follow up.
Thank you. Someone wrote in that there are questions that present themselves as to have the ability to increase the client's credit score or boost the credit score by multiple points. I think he's referring to like the Experian credit boost, which tracks your, you're familiar, your utility payments or something like that. Is this true? And does it stay at the higher level, or is it boosted for a short period of time and then reverts back to the initial credit score prior to the boost request?
Yeah, so there's actually two things that we're aware of that are kind of in the market right now, and I think there's some additional initiatives that are underway. So the Boost program works by looking mainly at utility, various types of utility data. The consumer has to give permission to give access to their bank account data. That's how the utility payments information is kind of derived, if that makes sense. And as long as they continue to give permission for that data to be pulled, it will be reflected in the score just kind of automatically from experience. If they at some point decide I don't want to permit access anymore, then the data falls out and it'll just be their experience score will be calculated based on the traditional information that's in the traditional report. Our sense is that we were watching this pretty closely. I haven't seen any updates in a couple of months on it, but most people did see an increase in score, and in particular, folks with lower scores tended to see more. It seems to be primarily a question of probably thin file consumers who don't have as many trade lines, and this is giving them an additional trade line where there's information about steady payments, and so that's probably why there's more effect in that kind of population. So, but like I said, it's been several months since we had checked the last reports. There are a number of blogs on Experian's website, so you can kind of go there and catch up and, you know, find more information about kind of what's happened in the program recently. There's also a product called Ultra FICO that is kind of in a testing phase. It's not generally available to consumers yet, but and it also is looking at bank account data more generally to provide a supplemental score to kind of traditional FICO. And I'm not exactly sure where it is in the process. I know they, the last we had heard they were planning to roll it out more generally in 2020, but obviously with the pandemic, I'm not quite sure where things are in that. In our cash flow reports, the larger project that I mentioned, the last report that we issued, which was in February, there's a kind of breakout box where we talk about all these other programs, and it lists a couple of other initiatives that are underway where other credit reporting agencies and kind of traditional credit reporting incumbents are starting to look at other sources of data to potentially help, particularly thin file consumers, potentially build a more robust score. So.
Thank you. Someone has a client that's been paying down a credit card which had a limit of around $9,000. She got down to $6,500, and the lender reduced her limit by $2,000. I think this is called like credit limit chasing. This commenter said it doesn't seem fair. What can she do?
So that's a tricky question, and I mean in general. We know that credit utilization and kind of the limit versus the use case is really important to scores and can make a big difference. A lot of limits are being reduced right now because lenders are kind of nervous in this economic environment, and there is some concern that that potentially can affect people's scores. It isn't an area that we spend as much time focusing on, so I don't know that I can speak to the specifics there, but we realize that utilization rates and kind of how that plays in can be an important factor, especially right now, and it is something that's helpful to think about as consumers are kind of managing their finances and kind of think about how they move forward right now. So that is a challenge. It's really challenging to manage right now, I think, because there's so many things going on with lenders making changes in the limits. So.
Okay, thank you. What are your thoughts about people adding authorized users to credit lines to increase their credit scores?
I definitely have heard about some people doing that. It isn't something that we've studied closely as to kind of how much of an impact it can make. My sense is that it can be helpful in some circumstances. I think obviously it's really important to make sure that it's someone you trust, and that it doesn't lead to kind of unexpected usage. But I can't really get into the details. I've never seen anything that explains kind of exactly how much of a difference and kind of where it's most effective or, least effective. So.
Thank you. On a previous call, someone states that HUD said that they would, that COVID forbearance would affect those HAMP terms as payments are not being made per guidelines. They said that the client would have to weigh which is more of a benefit, no payments required now or no payments required later. What are your I guess this is open to Bruce as well, thoughts on this?
Yeah, I'm not familiar with that. Bruce, do you have thoughts?
Yeah, I mean, the context was, it is this bizarre concern that servicers and lenders have that people would take advantage and go get a forbearance when they didn't need it. So they are overly talking about this issue as if this is the most relevant thing in this crisis, where we have record unemployment, reduced incomes. I mean, it's just this frustrating, sorry, this frustrating, crazy, off the rails kind of, it's just like, why do they start the waterfall with lump sum payments? That's the least likely outcome that's going to happen. But they always kind of go to, this is the thing, it's just absolutely, it's a very marginal piece to the whole picture. Always good to get a rant in every once in a while, isn't it?
Cool. Final question. Is the code listed in the same line as the account closed due to inactivity? Someone was looking through old credit reports for factual data and did not see any codes. So they thought maybe clients may not need them, but they just want to be certain.
Sorry, can you repeat the question? I'm not sure I heard the beginning.
Oh, sorry. I just cleared the question, so I can't do that.
No. Okay.
So
I don't.
I think they were looking for where to find the special comment code.
Yes.
They're just wondering where to look for.
Where is it listed on the report?
Oh, okay. Yeah, I don't know exactly. It's a narrative field, and the special comment codes that we're aware of are the ones that are disaster related, but I've gotten the sense that there may be additional codes that are completely unrelated to that, but I don't know exactly how it's listed. I will try and track that down and make sure to email Ellie back with the answer on that. Like I said, it seems to be a very, it's a kind of a weird utility field that people use for a lot of different things. So it may not really show up if there's nothing in that field. That's kind of part of the problem. Like I said, once a furnisher has decided to stop reporting a disaster code, it just goes away and you don't know it was ever there. So if there's no code on a particular account, you may not see it, but I'll try and double check that.
Thanks, those are all the questions.
Good. Well, thank you very much. This was excellent, helpful. Thanks everybody for their broad participation. Quick reminder about joining NHRC if you haven't already, and we still have a credit report discount and all those things, but obviously it's supporting the work, and especially our ability to work on getting greater funding in government and outside as well. And we'll continue working with you on all those things. I think the highlight here at the end is just to talk about next week's call. So Ellie, do you want to give a quick description?
Sure. So this is kind of a town hall sort of conversation next week. We want to hear from all of you about what your mortgage servicer stories are. It can be COVID related. It doesn't have to be COVID related. We're going to have a few experts on the call to kind of answer questions and maybe comment on the things that you're saying and engage in a conversation. So come with your stories and come ready to talk to us. Yep,
Going to be a group participation session. We haven't done anything like this in a really long time, so counting on seeing what you have to say, and you'll be able to speak. I mean, you can certainly use the question box, chat box, whatever, but you can raise your hand, and we'll let you kind of talk about what you're seeing in the field. And I think it's we just did a meeting with Kathy Kraninger at the CFPB a few weeks ago, and I was really just impressed with the depth of knowledge and broad level experience and the common themes that went through. I thought this would be better to do on a bigger forum so you can hear what your peers are coming across, and you can share what your experience is. So with that, I think we're going to end the call. Thanks so much, everybody. Keep up the good work.